Good day, ladies and gentlemen, and a very warm welcome to the Himatsingka Seide Q1FY22 post-results conference call hosted by Batlivala & Karani Securities Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Prerna Junjunwala from Batlivala & Karani Securities India Private Limited. Prerna?
Thank you, Ali. Good afternoon, everyone. On behalf of B&K Securities, I would like to welcome you all for 1QFY22 post-results conference call of Himatsingka Seide Limited. From the company, we have with us the senior management including Mr. Srikanth Himatsingka, Managing Director and CEO, Mr. KP Rangraj, President, Finance and Group CFO, and Mr. Dilip Panjwani, Senior Vice President and CFO, Strategic Finance. I would now like to hand over the call to Mr. KP Rangraj for the initial comments. Thank you, and over to you, sir.
Thank you, Prerna. Good afternoon, good evening, ladies and gentlemen. On behalf of Himatsinka Management, we would like to welcome you all to the first quarter FY22 earnings call. I hope you are all staying safe. You and your families are staying safe. I would like to begin with a business update, followed by a brief review of the financials for the quarter. So let me start with a business update. The demand environment across our key markets continued to be stable during the quarter. The Q1 FY22 saw a record consolidated total income of 819.88 crores due to enhanced capacity utilization levels across our facilities. We continue to witness strong demand for soft home products, and the order books for FY22 remains robust. The capacity utilizations for our manufacturing facilities during the first quarter FY22 stood as follows. Sheeting division 80% against 76% of the previous quarter. Terry towel division capacity utilization was 66% against 63% in the last quarter. And spinning division touched a capacity utilization of 102% against 101% that was recorded in the previous quarter. We expect to continue to enhance capacity utilization levels at our sheeting and terry towel plants. During the quarter, revenue streams from brands stood at rupees 582 crores versus 147 crores during the Q1 FY20 last year, and rupees 565 crores during the previous quarter. We continue to witness raw material inflation and supply chain changes. While the current quarter Q1 FY22 does not include any price increments, the same will begin to reflect starting the next quarter. In addition, enhancement of capacity utilization across our plants will aid in partially mitigating inflation impacts on the supply chain, value chain. The Union Cabinet granted approval on July 14, 2021 for continuation of the rebate of state and central taxes and levies, which is termed as the ROSCTL, with the same rates as notified by the Ministry of Textiles via its notification dated 8 March 2019 on both export of apparel and made-ups, and this scheme is extended up to March 2024. This certainty on the incentives will create level playing field for Indian textile players and help Indian textile sector increase its competitiveness. As a result of this approval and notification, we have recognized the benefit of ROSCTL of rupees 72.01 crores during the quarter ended June 30th, 2021, which is the Q1 FY22, out of which 35.32 crores pertains to the eligible export sales for the last quarter, which is Q4 FY21, which has as you remember, this was not recognized. The rates were not notified as of March 2021. I now move on to my next section, which is on the consolidated financial performance for the first quarter FY22. The consolidated total income for the quarter stood at 819.88 crores versus rupees 183.29 crores in the last quarter one, and rupees 748.04 crores in the previous quarter. This represents an increase of almost three and a half times year on year, and an increase of 10% Q1Q. The consolidated EBITDA for the current quarter was rupees 163.15 crores, was an EBITDA loss in the previous year of 80.72 crores, and an EBITDA of 129.66 crores in the last quarter. EBITDA margin stood at 19.9% in this quarter. The consolidated PAT for the quarter was rupees 57.7 crores, was a loss of rupees 139.8 crores in the last year, and a PAT of rupees 37.57 crores in the previous quarter. Debt profile. The consolidated gross debt as of 30th June, which is the end of the quarter, stood at rupees 2,566 crores as compared to rupees 2,467 crores at the end of the financial year FY21. The total term debt stood at rupees 1,694 crores, and the total working capital debt stood at 872 crores. The cash and cash equivalents stood at rupees 161 crores as of 30th June 21, is the end of the quarter. Consequently, the company's net debt outstanding as of 30th June 21 stood at rupees 2,405 crores. This compares to rupees 2,322 crores as of 31st March 2021. There is a slight increase in debt, as you will notice, during this quarter due to higher working capital pull on account of inflation and increased capacity utilizations. However, these are ordinary course fluctuations, and we remain focused on deleveraging our balance sheet going forward. With this, I would like to complete my update. We would be happy to take on your questions now. I would request our Managing Director, Mr. Srikanth Himatsingka, to answer the question and answer session. Over to you, sir.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone phone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Aman Santalia from AK Securities. Please go ahead. Aman, your line is unmuted. Please go ahead with your questions.
Yeah, good evening, sir.
Good evening.
Yeah. So my question is that since our plant is running near to peak capacity and the demand scenario is quite robust, so whether the company is planning to expand the capacity by debottlenecking the plant, and if yes, then how much capacity can be increased over a period of next 12 months?
Yeah. Aman, I've always shared with stakeholders that our plants are configured such that we always have the option of debottlenecking capacities should the demand scenario be encouraging. The demand scenario is indeed robust as one can see, and therefore the company is planning a debottlenecking exercise for both its sheeting plant and its Territal plant going forward. So, of course, we will, be more specific perhaps over the next few months. But directionally speaking, our ability to debottleneck sheeting will be taking the capacities to up to 108 million meters per annum, and Territal capacities to 40,000 tons per annum. This is what we will be directionally looking at. I would like to state here that these capacity debottlenecking exercises will be accommodated within the annual organic capex bucket that we have every year. So we have no plans to have any additional capexes at this point, but our scheduled organic capital expenditure that we incur every year, we can be debottlenecking our capacities within that framework, because a lot of the infrastructure and allied investments are already made at our campuses.
Sir, since I think we use very high quality cotton for our shipping plant, so if you explain whether that quality yarn is available in the market?
So we use all kinds of cotton yarn, Amanji. We use a lot of cotton from India and overseas, and we use various staple lengths of cotton. So there is no dearth of cotton availability, to answer your question.
And so one more question: why there is sudden jump in the salary cost?
The salary costs are moving up in tandem with, essentially two things: plant ramp-ups that are happening, and B, the annual inflation that kicks in typically, from a standpoint of the increment cycle. And three, we have started providing for some, annual bonus payouts and other normal course and ordinary course incentives, which were not active in the last fiscal. So it are essentially these three buckets that are contributing to that movement.
So it will be a regular phenomenon, sir. In the next coming quarters, the salary cost will be very much like this.
Yes, this is not an aberration.
Okay. And sir, one last question. When we can expect that 23-24% EBITDA margin, whether in the near future or within a year?
Amani, I'm not aware of the 20. You mentioned 23-24%. Is that what you mentioned?
Yeah, sir. Previously, in the few years back, we were used to have 23-24% EBITDA margin. That is what I'm asking.
So we had spoken to stakeholders about an EBITDA band of 18 to 22% during our last call. And we are well within that framework. But our EBITDAs were impacted this quarter also, on account of a couple of other things which I can take you through. We have to forego approximately 3.5% of revenue on account of supply chain congestion, which created a sort of one-time hit. I don't know if I can call it one time, because should it repeat itself, then it's an ongoing hit. But there's a revenue lag of approximately 3.5%, which hurt our EBITDA margin by approximately 1.7 or 1.8% for the quarter. Point number one. Point number two, Himatsingka has not, had any price enhancements of any consequence during this quarter. Any price increments will start reflecting only from the second quarter. And the third impact, is arising out of our dollar realization figures, which are probably lower by 1 to 1.5%, on a comparable basis in the industry, because of the fact that Himatsingka had stopped booking forwards around the same period last year. So when the lockdown was announced, and for the quarter consequent to the lockdown, we had taken a stance of not making forward bookings in the absence of clarity. But and therefore, some of our forward rates are impacted because of that move. So these three buckets / reasons impacted our operating quarter to the degree that they did during the quarter, our operating EBITDA. Going forward, however, with some ordinary course or partial price increments that we spoke to stakeholders about, enhanced capacity utilization, better operating efficiencies, and some realigning of our supply chain on the sourcing side, will help us mitigate this inflation that we witnessed during the first quarter. And our operating EBITDA margins should be headed back to more to the 20-22% range versus the wider band of the 18 to 22% that we had stated earlier.
Okay, sir. Thanks a lot for the elaborate answer.
Thank you very much.
Thank you. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Hello?
Yes.
Yeah, my question has been answered. Thank you.
Thank you.
Thank you. The next question is from the line of Riya Mehta from Aquitus Investments. Please go ahead.
Good afternoon. Thank you for the opportunity. Actually, I was a little late in the call. I wanted to know if the capacity utilization for each of our basically products. And secondly, what kind of price hike are we envisaging that will get come into play by Q2? And my third question was, do we get impacted by freight costs or it's usually passed on to the customer?
No. Thank you for your questions, Riya. The answer to your first question, the sheeting capacity utilization was 80%. The Territal plant's capacity utilization was at 66%. And the spinning division clocked in at 102%. The second question in context to price increments is, I'm afraid I can't be specific on that one, but it would be typically, mid-single digit kind of numbers that would probably be the range that the industry witnesses, as far as price increments are concerned. And as far as your third question on freight is concerned, there is not just, there's been supply chain congestion and there's been inflation on the freight front. And these buckets of costs or the kinds of costs are not passed on to the client. The client is basically in most cases bearing it because a lot of the freight costs, outward bound freight is borne by the client. But there's a lot of freight inflation even on inward freight and and things like that, which is borne by us.
Okay. So how much impact can we expect on margins considering what we understand Q2 freight costs have almost like doubled?
Yeah, the freight costs won't swing the performance in any in any material form and shape. It will be the raw material inflation that's going to be having an impact. But as I said, the mitigation measures of partial price increments, enhanced capacity utilization, some realignment of supply chain on the sourcing front to be able to reduce some of our input costs for some bought out products and raw materials. In addition to operating efficiencies, will help us mitigate the impacts. And our EBITDA margins should be headed in the direction of 20-22% vis-a-vis the larger gap of 18 to 22% that we had earlier indicated.
Okay. And if I could just add one last question, if you could give us deleveraging target for the year.
We started out with a deleveraging target of approximately 150-200 crores. We broadly hold that target. The inflationary impact on working capital has been being witnessed as Ranga read out. We have seen some movement of 2-3% on our debt portfolio. But directionally, we are headed in deleveraging our balance sheet. on the one hand and enhanced EBITDAs on the other hand. Of course, I'd also like to clarify that the EBITDA percentages that I referred to, will more than mitigate any tailwind that we've had from ROSCTL accruals from the past quarters. So this is obviously, excluding any such impacts, 22% is the direction that we're headed in.
Okay. Thank you.
Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Mithun Aswath from Kiva Advisors. Please go ahead.
Hi. I just wanted to understand, obviously our utilizations are moving up. At what point would we need to incur further capex? And I also saw that you were, there's a resolution to raise capital of about 1,500 crores. Was this just an enabling resolution? Are you looking to raise equity at some point? So just wanted to understand. Those are the couple of questions I have. The last one is more of a longer term, view and where you want to take this company over the next 3 to 5 years. What would the longer term vision for the company be? So these are the questions. Thank you.
Right. So thanks for your questions. So vis-a-vis your first question in terms of at what point will we start looking at fresh capacities and capex, given the current utilization numbers. So the answer to that is about now. As I stated earlier, we are already exploring debottlenecking both our capacities at our sheeting plant and our Territal plant. Sheeting plants to be debottlenecked to up to 108 million meters per annum, and our Terry plant to be debottlenecked to up to 40,000 tons per annum. So this is in terms of the capacity, directionally speaking, that we will be exploring to debottleneck our plants to. Of course, we will make more specific announcements as and when these plans are crystallized. In terms of the capex that will be required for this, Himatsingka has made it clear that it is not on any, it is not on a capex sort of mode at this point. However, we have always shared with stakeholders that we have ordinary course organic capital expenditure every year, and our debottlenecking exercise will be accommodated within that gambit. So, we don't plan to incur any over and above capex for these debottlenecking plans. I'm sorry, what was your second question? The second question was with regard to the resolution. It's a pertinent question, and I'd like to answer that as well. So the 1,500 crore number that you spoke about, you are right. It is just an enabling resolution that we are equipping ourselves with. The company has no plans to raise any equity at this point, and I wanted to make that clear. Although we, by passing this resolution, we will be equipping ourselves to have the ability to raise it, but I'm clarifying that we don't have any plans to raise equity at this point. Secondly, there are opportunities that crop up in debt capital markets, both onshore and offshore. Vis-a-vis, optimizing cost and tenor of debt, and Himatsingka wants to make sure that it is aligned to be able to tap into any opportunities that might come up from time to time, and hence has taken an enabling resolution. We would like to also clarify that we have no intention of enhancing our debt or leverage in any form and shape, and we will be focused on continuing our deleveraging exercise going forward. However, this enabling resolution will only equip us to explore a broader set of instruments that might be available globally for optimizing some of our portfolios. As far as your third question is concerned, in terms of where we are headed over the next 3 to 5 years, well, let's talk about 3, and let's keep it more specific to our current businesses, because new opportunities and new businesses is a different conversation. But vis-a-vis our existing businesses, we feel there is ample headroom for growth in our home textile solutions vertical, which we will be focused on. The debottlenecking initiatives that I spoke to you about just now will give us a lot of scope to grow both our businesses on the bedding and bath front. And the group will also explore, expanding its yarn and fiber solutions vertical should the opportunities arise. So I think directionally speaking, without sharing specific numbers at this point, we will be focused on growing these verticals, our home textile solutions vertical and our yarn and fiber solutions vertical, over the next 3 years. And we think that the growth momentum should be fairly robust, is the way we look at it at this point. The group is not just strong on manufacturing. We operate 4 facilities across 2 campuses. We operate world-class infrastructure. But in addition to our manufacturing prowess, we also have a very strong portfolio of brands that sort of accentuate and strengthen our integrated model that we operate. We currently have a clutch of over 15 brands that sets us apart in industry. And so while we will be focused on sort of growing our manufacturing capabilities and scale, we will also be focused on making sure that our brand portfolio remains robust and we are adequately spread across channels. So while we feed into a lot of traditional channels in the world of retail, we will be focused on enhancing our digital footprint and our e-commerce footprint going forward. These are initiatives which are already underway, but are going to gain more and more traction over the next 3 years. So that will sort of, so the 3 years will look like more in, directionally speaking, will look like enhancing scale and capacities, enhancing our intellectual property portfolio strength, and broad basing our channel mix, by being much more digitally focused, B2C focused, by building B2C focused revenue streams as well. I hope that gives you some light as to where we are headed.
Thank you so much.
Yeah. Thank you.
Thank you. The next question is from the line of Kaustubh Pawaskar from Sharekhan by BNP Paribas. Please go ahead.
Yeah, good evening, sir. Thanks for giving me the opportunity. Sir, in your initial comment, you mentioned about strong demand environment in the export market. So can you give us some broad view on the same? What is your current order book, or how is your order book shaping up over the next few quarters?
Well, our capacity utilizations continue to climb. They are not climbing more rapidly at this point because we are conscious of what we're taking on. But our capacity utilizations continue to increase, and the order books remain robust. Unfortunately, we don't disclose the value of the order book because it changes from time to time and it's dynamic. But what I say, and I've shared earlier, is we are confident of, at this point, subject to issues arising out of COVID and lockdowns and things like that, which I cannot comment on. But other than in those circumstances, we feel reasonably confident of continuing the momentum that we saw in the first quarter of the fiscal into the rest of the year. And our order books at this point seem to be supporting that. That's the way we see it.
And anything on customer front, are you having interaction or any new customer which has been added to your list in the recent time, which will help in future to improve your order book ahead?
Yeah, good question. Himatsingka is continuously focused on enhancing its client base, its channel mix, right, and its brand portfolio, its strength of brands. So vis-a-vis the first point, we are seeing a fairly substantial enhancement of our client network and client base, especially after the Territal plant's been commissioned. So we have a fairly broad-based client network that continues to expand. So to answer your question, yes, we have been adding a lot of clients over the last year and continue to add clients, both on for our bedding products portfolio and for our bath products portfolio.
Right. And so one last clarification on the margin front. You mentioned that your operating margins would over at 20 to 22%. So this is including your ROSPN benefit, or this will be excluding that?
Yeah, I mean, even in the past it was 20 to 22%, including export benefits, and it will head back in that direction. Of course, I'm excluding any benefit that, like for example, in Q1 there was a benefit of ROSCTL accruals that came in from Q4. So the 20 to 22% includes benefits, but only for that concerned quarter.
Okay, sir. Thank you. Thanks for the clarification.
Thank you.
Thank you. The next question is from the line of Anurag Jain from Green Lantern Capital. Please go ahead.
Yeah, thanks so much. Am I audible?
Yes, Anurag, please go ahead.
Yeah, thanks so much. Just wanted to understand the business model on the branded portfolio side. How does it work? I mean, do we give the products to these brands and they sell it, or it is so we in-license the brands, we sell, we manage the inventory, we manage the working capital, we pay a royalty, we distribute, we decide where to sell, how much to sell. So if you can explain how the model works.
Sure. Is that your only question, or you have another question?
No, this is all I have.
Okay. So Anurag, the way it works is more of the latter that you referred to. So Himatsingka has the right to design, develop, manufacture and distribute the licensed brands that it undertakes. So, and therefore it is responsible for all sales, all distribution, all inventory management, all client-facing dialogue, and so on, all product development, all manufacturing. So it's a full suite of responsibilities that come with brand licensing. And it's a know-how that we have sort of developed over the years. And so that's really how it works, and we then pay a royalty for what we sell. That's traditionally how brand licensing works in most textile categories.
Understood. So is it higher profitability, higher return business versus manufacturing, more resilient? How do you see this business?
Well, I've been asked this question before. It's not necessarily higher margin. It could be in some instances and it may not be in some other. But what it does do for us is, since these licenses are exclusive to the group, revenue streams are not subject to, bidding pressures and things like that. They also create, I would say, enhanced stickiness as far as our revenue streams are concerned. Sometimes slightly marginally better pricing power. And of course, global access and reach in across client networks and channels, from time to time are also benefits that one from a strong portfolio of brands. These benefits are not necessarily always measurable, and they're not necessarily linear, but these are definitely broadly speaking, the kinds of benefits we have experienced over time.
Understood. But just one last follow-up on this. So this is exclusive global rights for these brands that you have, right?
Well, some global, some more region-centric. So some might be just for North America. Some are global in nature. Some are North America and Europe. Some are, and things like that. And then there are some own brands that the group has, which operate in certain regions, etc. So it's not always global. It's what makes sense for the brand.
Understood. And just one last question. At what rate is this business growing, if you can share that? That's all from my side. Thank you so much.
It broadly, follows an organic growth rate, Anurag. It's, I would say in the, high single digits to low double digit numbers, thereabouts is what one would reasonably see in these businesses, if I take a medium term perspective.
Yeah, got that. Thank you so much. That's all from my side. All the best to you. Thank you.
Thank you.
Thank you. The next question is from the line of Prerna Jhunjhunwala from B&K Securities. Please go ahead. Prerna, your line is unmuted. Please go ahead with your questions.
Yeah, am I audible now?
Yes.
Yes.
Congratulations, sir, on improving traction on capacity utilization. And just wanted, I know you said that you'll give more clarity on expansion with time, but by when should we assume that these capacities expansions would complete, maybe in 1 year, 2 years? And what really gives confidence on such huge capacity expansion, especially in the bedsheet business? Because 108 million meters is a very high improvement on current capacity. So just wanted some clarity on brands, B2B, region-wise clarity. Would just help in understanding the direction in which we are moving.
A fair set of questions. So as far as timelines are concerned, I would think it's over the next 12 months. It can be implemented in phases earlier. As I said, we'll be more specific about it with time, but it could come in phases earlier. But it'll all be sort of implemented over the next 12 to 14 month time period, if not a little earlier. To the second part of your question, let me start with Terry Towels first. Himatsingka commissioned the plant in October 19 with a capacity of 25,000 tons per annum. We operated the plant for 4 months before hitting a lockdown in March, and then we restarted our operations in June, July, when the lockdown was lifted. In a sense, we have operated the plant in its entirety for maybe 14 months. We have ramped up the capacity to close to 66%. So we've clocked 66% from 0 to 66% in about 14 months, which we feel is quite satisfactory. And it is on this ramp up and this strength that we feel that the debottlenecking from 25 to 40,000 tons per annum should be something that we can easily sort of, navigate. Of course, that doesn't mean that, everything's going to happen overnight, and there will be some challenges along the way. We are used to challenges. But this is essentially what's driving the thinking when it comes to the Terry Towel plant. When it comes to the sheeting plant, yes, it is a jump of sorts, but there are certain minimum configurations that need to be, that are optimal and that need to be put in place one doesn't have the option of increasing capacities in small marginal increments. Therefore, the next logical step vis-a-vis our infrastructure and our configuration is that number of 108. But it would be more like part of that capacity sometimes is not available because of product mix and other challenges that come in from time to time. But given the current visibility we have, even on the sheeting and things like that, we think it's a good thing to have in terms of capacities, because sometimes opportunities also present themselves in fairly substantive ways. Be mindful of the fact that there's a lot of socio-political undercurrents that may cause opportunities to crop up for Indian players in going forward, and one must be equipped with capacity at that time to be able to tap into such opportunities. The cost of idling some capacity, if the need be, isn't really much, because these are all debottlenecking initiatives and within our organic capex ambit. And therefore, keeping the socio-political movements and other macroeconomic forces that are acting on global demand patterns at this point, we find it prudent to be able to equip ourselves over the next 12 months with some incremental capacities, even on that front.
That's quite encouraging, sir. Also, if you could just highlight on the traction in the Europe region, that will be helpful.
Europe's progressing well. We are garnering market share in the European region. I think that traction will continue. Disney will give us a fillip as well in the months and quarters to come. So we remain on course as far as our European market share sort of expansion is concerned, for both bedding and bath products.
Thank you, sir. This is quite helpful.
Thank you very much.
Thank you. The next question is from the line of Amit Kumar from Determine Investments. Please go ahead.
Yeah, thank you so much for the opportunity. Sir, I just wanted to sort of correlate, your capex and expansion plans with vis-a-vis, a view on, how does the demand, the end user demand for your products is sort of shaping up now, but also 2-3 years, down the line. So our understanding is that majority of the product, basically, the home solutions products gets exported to US, and the fundamental volume demand growth in that market is like 2-3%. But last 12 months, it has been very, very strong, even, compared to, let's say, 2019 levels, a double-digit, kind of volume expansion. And as you sort of also mentioned, the near-term visibility, also remains pretty good. The question that we have is that more from a medium-term perspective, do you sort of see this kind of, demand trends, double-digit volume growth essentially continue? Or does demand sort of go back to, normal? So our understanding is that this is more of a work from home, so home becoming the center of, your world kind of situation. But now with vaccines coming in, people in US, Europe, they are sort of stepping out and mobility trends are, just starting to normalize. So I just wanted to sort of get, a sense of how you are looking at demand. I think you talked about, the near-term visibility. But how are you seeing this in the medium term? And an associated question with that is, aside from US, what kind of, opportunity set do you see? What are the other markets? Europe, you sort of talked about. What are the other sort of opportunity markets, and what kind of opportunity set for the company, for the industry, that you see? Because our understanding is US, India is already in this segment already capturing a 50-55% kind of market share, maybe that sort of still continues to go up. But there are obviously limitations now because the level is already sort of so high. So what is the next sort of leg of growth in terms of geography or in terms of sort of specific countries that you have in mind?
So a fair set of questions. Amit, right, you said? Sorry.
Yes.
So Amit, a fair set of questions. Let me try and address all of your queries. So as far as demand, our sort of view on demand outlook over the next 3 years and how the sort of puzzle pieces itself. Obviously, there's no definitive binary answer to these things. These are dynamic and intangible metrics from one standpoint. But there are data points and industry experience that drive this thinking as well. So first and foremost, one must look at both the bearing portfolio and bath portfolio as a combination of several subsegments, which may or may not come through in plain vanilla data extraction from OTEXA. There are several subsegments in the bearing portfolio that actually make up the total revenue streams in that segment. And Himatsingka probably operates one of the widest, probably offers one of the widest spectrum of products, in these verticals. And so, we will be looking to enhance our offerings across these verticals, which then cumulatively will translate to larger capacity, throughput. If you look at it from that lens, it's not such an intimidating statistic as it is made out to be, because of the several subsegments which may or may not be covered in that piece of data that you're referring to. That's one. Second, all of this capacity is not headed to the United States of America. There are other pockets of opportunity that are presenting themselves, and one has to be positioned to be able to capitalize on such opportunities. Why? Because one cannot put up or debottleneck capacities in short notice. By the time one gets plant and machinery and whatever else needs to be set up, these are fairly long lead projects. I wouldn't say project is a broad term. Long lead initiatives, which can't be implemented in 1, 2, or 3 months. They typically take some time. And so one would have to start planning for it in advance, because it's not just the United States, but there are pockets of opportunity emerging in Europe. We've all read sound bites of
the line for the management seems to have disconnected. Please hold while we reconnect them. We have the management line reconnected. So you have been unmuted.
Yeah. So, I was saying that the pockets of demand are coming not just from the United States, but from various other geographies. And, we have all read sound bites about, potential opportunities cropping up for India in general, vis-a-vis the European region, and so on. We feel that we need to be prepared to take on, emerging opportunities across these jurisdictions. And at some point that will include India as well, as far as Himatsingka is concerned, to feed into some of the demand emanating from India and Asia Pacific regions. So that's my second point. So my first point is, there are several product subsegments. Our product offerings comprise of various kinds of products, and one has to look at them in the breadth that we offer these products to be able to sort of marry capacity and product offering. Second, it's not just the US, it's several pockets of opportunities. And third, there are movements which are more sudden in nature and are more substantive in nature because of the socio-political sort of forces at play, which I briefly alluded to. Of course, these are not definitive predictions, but we want to be prepared for such eventualities. And the fourth part is, don't be perturbed by just the number of MMPA. There is always some part of capacity that may or may not be utilizable because of product mix and so on. So, it may be, it may not be. One has to be mindful of that. And then the fifth part is, there's certain minimum optimal configurations of capacity that need to be kept in mind, and one can't just enhance capacity in marginal increments the way we please. So these are the various points that we have kept in mind while thinking in this direction. As I said, more specific plans will follow, but over the next 12 to 14 months, this is a broad sort of direction that we would like to take. And mind you, I'd like to remind everyone that this is within the ambit of our organic capital expenditure program and nothing beyond that.
Thank you. First of all, thank you so much for the detailing, sir. My second question, just one sort of small follow-up on this. Looking at, again, not sort of specific to your company, but, looking at sort of across the, spectrum of listed companies in this space, we sort of typically see a lot of discussion around, the sort of traditional retailers, although I understand they also have their, they have also, progressed quite further in their e-commerce, plans. So the Targets of the world, the Walmarts, the Bed Bath and Beyond, and so on and so forth. Surprisingly, very little discussion on Amazon. Now, our understanding is that Amazon right now is very, in terms of sourcing, China is, of course, their major, sourcing hub. So two questions really. The scale of opportunity is, sort of very, very clear. But within the ambit of this entire China plus one, theme, what are the challenges that you face in terms of breaking into, with respect to the scale of the company also, that this question is sort of specific to, the company. Is that sort of opportunity set? Because our understanding is that Amazon obviously likes to work, at scale and at lower margins. So is that an opportunity set which is right now available only to the biggies, like the wealth funds of the world? Or is that sort of opportunity set, open to you as well? Then, of course, what are the challenges that you face? Because not really seen, anybody in the listed space sort of really talk about, Amazon in a very big way, so to speak.
So within the three or whatever names in the industry, in the listed space, everybody's capacities are beyond a threshold which will give them the essential qualification to tap into any retailer, right? So no one's capacity is small or undesirable in the eyes of a retailer from a standpoint of scale? So that's my first question, and therefore everybody qualifies to be able to sell to everyone vis-a-vis the lens or the qualification, if the qualification criteria was scale of capacities. So therefore there's no big, or there could be relatively big or small, big or small, but the absolute scale across major players, make them qualify to be able to tap into any retail opportunity from a standpoint of scale, right? The second point is zooming more into the world of Amazon. To the best of our knowledge, Amazon does not have a geographical preference as such vis-a-vis our products. Amazon has a proposition preference. Amazon purchases and or sources things that make sense to it, right? That either give it a stronger brand presence or a stronger private label presence or a stronger value proposition, and so on. And it is largely by what's on offer, not where it is from. So I don't think, and again, this is our personal view, this is our view as Himatsingka, we don't think that opportunities vis-a-vis Amazon are restricted either by scale or by geography. They are directly correlated to the quality of propositions that we make to that client vis-a-vis brand and private label opportunities, and how it makes sense for their universe. So therefore, I don't think one should be feeling that these opportunities are capped directly or indirectly, vis-a-vis any of the players. I hope I've clarified your point.
To a large extent, yes, but then again the question is that Indian home textile manufacturers are able to tap into the Walmarts and the Targets of the world in a very big way, but not Amazon. So is there any sort of specific?
It's also the pattern of shopping. The e-commerce channels don't shop the same way as the brick and mortar channels do. Therefore, the volumes and things of that nature are not comparable when it comes to the regular shopping that the brick and mortar arms of the retailers do, or in this case, Amazon of course doesn't have a brick and mortar piece, but difference between these two ways of shopping, and the e-com is way more fragmented, like infinitely more fragmented in terms of approach than just regular brick and mortar revenue streams. And that's why you feel that we as an industry / a bunch of players tap more successfully into the brick and mortar space than the e-com space because of the underlying fragmentation.
Okay, interesting. That's it from mine. Thank you so much.
Thank you very much.
Thank you. The next question is from the line of Akhil Kaluri from Franklin Templeton. Please go ahead.
Thanks a lot for the opportunity. I had a couple of questions. First, on the revenues itself. So the current revenue run rate quarterly is to the tune of about $100 to $110 million. And you're talking about potential expansion in both sheets as well as towels. So just wanted to understand if there's a reasonable amount of visibility of achieving optimal utilizations maybe over the next 12 to 14 months or so, which is giving us confidence of expanding capacities further. And in that case, what can this potential revenue run rate be by the over the next, say, 4 to 6 quarters from now?
So, as I was sharing with earlier, we have enhanced our capacity utilization in our Terry plant, which was recently commissioned. So from 0 to close to 70% over the last 14 months, having been interjected by the disruptions of the pandemic. So in that backdrop, we thought that the ramp-up's been pretty robust, and that gives us the confidence, along with the fact that we are seeing demand on the horizon, gives us the confidence of debottlenecking our capacity, potentially speaking, over the next 12 to 14 months. And the same with sheeting. So I would say we have reasonable visibility and reasonable confidence to be able to undertake these things. They are more ordinary costs in nature and will be within our organic expenditure program. Should we succeed in placing these capacities, and operate at reasonably high utilizations post such debottlenecking, the revenue pattern will be largely pro rata in nature. So, for example, if we were to look at close to 75-80% utilizations post debottlenecking of capacities, then that versus where we are today would be, broadly speaking, range-bound pro rata journey. It could be slightly lower than pro rata or slightly higher than pro rata, depending on product mix. But for a thumb rule estimate, which is the best one can do at this point, is assume that it would move in a pro rata manner.
Sure, sir. My question was more about the existing capacity itself, because on towels, it's really commendable that within 14 months we've reached about 66% kind of utilizations. But given that the company is already planning further expansions, and till about a few quarters back, the entire focus was on sweating the existing assets. And therefore the question was, over the next 12 months or so, do we have reasonable amount of visibility that the existing capacities in both sheeting and towels will probably hit close to optimal utilizations?
So per the current run rate and per the current visibility, we feel reasonably confident to be able to place the current capacities, because we don't have much left. We are at 80% in sheeting, and we are at close to 70% in terry towels. And we are looking at progressive increases in fiscal 22 itself, as we indicated earlier. So we don't have much headroom here. Please be mindful that once one starts hitting the 90% mark, there could be product mix variations and or other sort of restrictions that sometimes come into play in sweating assets in their entirety to 100%, although that's also possible. But keeping all these factors in mind, we are taking steps in advance to be able to debottleneck capacities. I'm cautious to use the word expansion, although it's a resultant enhancement of capacity. I'm more comfortable with using the term debottlenecking, because we are essentially tapping into a lot of existing infrastructure that exists at our campuses.
Fair point, sir. And just for our understanding, this while you indicated that the capex will be in line with the organic capex that we generally plan every year, would you be able to quantify a ballpark number over the next, say, 24 months? What is the kind of capex outlay that we are looking at?
No, every year, so our major capex is over, is what we had shared with stakeholders. And every year we spend 60 to 80 crores on organic capex, which is also something that we've always shared with stakeholders. So, if it is, it's going to be within this gambit, in the next 12 to 14 months. So maybe it'll borrow some from this year and borrow some from the next year in terms of buckets, and be within that.
Fair enough. So in the ballpark range of 60 to 80 crores per annum here or there over the next couple of years. Great. The second question I had was also on balance sheet and the leverage which is there. So if I look at the net debt number for about 4 quarters now, it's in that range of between 2,300 to 2,400 odd crores, and that's despite healthy EBITDA run rates over the past 4 quarters. I understand that there would have been certain amount of working capital increase which have happened, and further there could be certain government receivables as well, which would be stuck. But if you can help us give a little more color in terms of the nature and potential for working capital release from current level onwards.
I think it'll be if you look at FY21, we reduced net debt by approximately 268 crores. During FY21.
Right, but sir, if I remember the numbers right, I think bulk of that deleveraging happened during the second quarter itself, and from 2Q end to 1Q22 for about 3-4 quarters now, the debt levels seem to be broadly flattish.
Yeah. So I don't recall which quarter it was which saw the highest movement. But essentially, during FY21, we reduced by just under 300 crores in terms of net debt. It's been flat of late, but it's also on the back of pretty high inflation levels that we are witnessing, and capacity utilization enhancements at our facilities. But our major capex having been sort of largely concluded, I had shared with stakeholders that there's some small parts that are still left and are underway, but bulk of it's all over, and therefore we are focused on deleveraging our balance sheet. So we will continue that focus. There could be some timing differences from Q to Q. You're right in your observations in some capital being stuck with the central government on account of the incentives and so on. But I think largely one will see deleveraging patterns shape up or surface going forward.
So any numbers that can be shared in the form of money which is stuck with government, if there is anything of extraordinary nature, which we can probably expect over the next few quarters?
It's the usual that the industry has as well. It's nothing specific to Himatsingka. So once that comes, that's one bucket. And otherwise as well, we had some working capital pull this Q, but directionally we should see it correct on the one hand, and from the other hand, our EBITDA should hopefully continue to climb, and so our leverage ratios will correct from both the reduction in debt standpoint and the increase in EBITDA standpoint, because it will, the results of our investments in the various plants over the years, over the last 3 years, etc., will finally start to, show up. It's already started, but that show will continue to be able to rationalize our leverage ratios.
Sure, sir. Thank you. Thanks for this.
Thank you.
Thank you. Due to time constraints, that was the last question. I now hand the conference over to Mr. Srikanth Himatsingka for closing comments.
So as usual, it was such a pleasure to interact with everybody. I do hope that I threw light on most of your questions. If you have anything that remains unanswered, get in touch with us, and we'll make sure that you have the clarity that you need. And until then, stay safe and speak soon. Thank you very much.
Thank you. Ladies and gentlemen, on behalf of Batlivala and Karani Securities India Private Limited, that concludes this conference call for today. Thank you for joining us, and you may now disconnect your lines.